Welcome to this month's monthly market trends report, where we take a look at nationally where the market is, but also where's the market going? What does it look like here for us locally in northern Colorado? So big picture, we look at the big picture of where we're at. We reach out to a lot of our different analysts, and there's always some adjustments that are being made ongoing as far as the different forecasts. And a lot of that really depends on the changing of the interest rates, the changing of our inventory. We have a lot of, when you look at inventory, what impacts our inventory the most is new construction. And a lot of times, those are all taken off of starts, which are documented when the permits are pulled with the city. So we're really dependent on how the city reports all of those different permits and so forth. So sometimes there's going to be a lot of fluctuation. But in this graph here, it'll show the difference. We used to always talk about a buyer's market and the seller's market. This graph really will show and demonstrate what we've always talked about, which is we look at inventory and we say anytime inventory is above 5, 6, or even 7 months, we're sitting in more of a buyer's market, because there's more inventory, which means that the sellers have to be more aggressive in their pricing to attract and make it look like a better deal. Versus below that number, below that 5, 6 month inventory is more of a seller's market, which means that sellers can tend to price their home a little more on the higher side in speculation, and many times, if it's in good condition, get their price. So when you look at this, going all the way back into the late 90s, we are still in a seller's market, even though there's been a lot of adjustments in the last 6, 12, and even 18 months. So there's a lot of talk about us going into recession, and that'll likely happen. And they anticipate it's going to probably happen later this year. We're going to probably cycle through that recession, and it'll probably take about 2 years to cycle through that recession. But the big question is how does that affect us in the housing market? How does it affect us with our housing prices? Well, when you look here at this graph, you go back to the last 6 recessions, prices only fell 2 different times in those recessions. And one was the mortgage collapse in 2008 when all the banks collapsed. We had all the foreclosures. But when you look at three of the last years in those recession years, it actually, home prices grew by 6% or more. So just because we hear talks about going into recession doesn't mean that we're going to have falling prices and that our economy is gonna collapse as well. So be careful what you look at. Again, that's why you're here, is to get the latest and greatest, and we want to share those numbers with you so you can make better decisions. So from a real estate perspective, also, when you look at interest rates, we show you in this graph here historically with recessions. The last 6 recessions that we went through, we also saw interest rates drop. And so we anticipate by end of year, we're going to probably see interest rates sitting in maybe the low to mid 5s. Again, there's some different variables that are going on globally that we don't know how that's going to impact us, but that's what they're anticipating right now. So when we look at how strong our real estate economy is, and this is a lot of the different analysts will look at when they're forecasting, because a lot of people talk about foreclosures and will people be losing their homes, and unfortunately that will happen in certain situations. But in general, when you look at our economy and you look at the state of the union when it comes to real estate and home ownership, we are sitting in one of the most strongest stable markets in decades. When you look at our graph here, over 80% of mortgage holders, people that have mortgages on their homes, they have a rate of 5% or less. And of those, over 80% of those have rates below 4%. So their current rate on their existing mortgages is extremely low, which puts them in a very good position from sustainability. Additionally, what we look at is the equity of homeowners, which is at an all-time high. On this slide, you'll see over 38% of homeowners have paid their mortgage off on their home, and their home is debt-free. When you look at 28% of homeowners, they have over 50% equity in their home. So they're sitting in a really good position when it comes to their equity in their home and their financial situation. So as we go forward and we progress into the summer market, we anticipate that we're going to start to see increases in inventory because it's summertime and everyone loves to move in the summer. Kids are out of school. Weather is more convenient for moving. So we will see inventory increase, but also we are already seeing a large increase in the surge in the bubble of buyers that are out there. Now, the one thing that many of the lenders are saying is because rates are, sort of in that high 6 range, even, tickering in the 7, it's still pricing some people, even the largest pool of buyers, out of the market, which is the millennials. And what they anticipate is by third and fourth quarter, when rates do come back down, they're anticipating that we're going to see those millennials come back into the marketplace, which just means they're going to consume even more of that inventory, which means that prices are anticipating that the prices will continue to push upward. So those that are sitting on the fence, they ask, is it a good time frame or timeline to buy? In my opinion, yes. When we look at how the market flattened out from July through December, January, then the market got really soft and flat. Well, what happens at a flat market when there's not as much activity? What happens is if a seller has to sell based on their motivation, they're going to tend to price it more aggressively, which means they're going to price it below market to get it sold, to push it, to move it faster. So we have seen in certain pockets of our market, we've seen a little bit of softening in prices, but because we're starting to see a larger pool of buyers come into the marketplace, we're starting to see those properties be absorbed, and now we're starting to see an upward trend in prices. So when we look at first quarter, if you look at first quarter, on average in the national market, 92% of markets actually rose and gained 1% in value, which is going back 5 months from now. Previous 92% of markets were depreciating or declining by 92%. So again, we're on the uphill. We're in the uphill swing. We anticipate a great summer. We anticipate rates are going to continue to work their way down. The great thing is that a lot of the lenders, especially the great lenders, are also being very proactive in some of their mortgage programs, where they're also building in the opportunity where for buyers where they can actually refi for a nominal cost down the road if rates drop. They're building it in. We're giving them that option to refinance it down at a nominal cost because we anticipate that rates are going to come down and it will be more affordable. So as always, if you have any questions, let us know. And here we'll break down the numbers, also individual markets, looking at here in Will County and Larimer County, as well as also Boulder County and the Denver metro area, just sharing where we are as far as the local absorption rates, average sales price, diesel market, and so forth. As always, if there's anything we can do to help you out, we're always happy to do so. Feel free to give us a call at 720-230-3030. Remember, my team will be there to help you, or you can always reach me directly, 970-396-7248. For this month, Kevin Schumacher Team, always here for you, and appreciate as always your business and your loyalty.